The giant AI bubble has finally developed a visible crack, not another warning from a skeptical economist, a fracture violent enough to stop an entire stock market in the middle of trading, and the first scream did not come from Silicon Valley, it came from Seoul. For years, the artificial intelligence boom has looked almost indestructible. Money poured into chips, servers, data centers, power plants, cooling systems, and companies that promised to transform every industry on Earth. Each new investment justified the next one. Higher demand produced higher forecasts produced higher stock prices, and higher stock prices made even larger investments appear reasonable. The bubble became so enormous that people stopped seeing it as a bubble. They began treating it like the weather, something surrounding everything, something too large to fail, something that would simply continue. Then South Korea cracked. This matters because South Korea is not standing at the edge of the AI economy. It is buried deep inside its engine. Samsung Electronics and SK Hynix manufacture the memory that allows artificial intelligence systems to process mountains of information. Their chips sit inside the servers behind the models, the chatbots, the cloud platforms, and the data centers now consuming entire power grids. These companies are not speculative startups with no products and no revenue. They are among the most important industrial companies on the planet. They are profitable, they are technologically essential, and they have just reported some of the strongest results in their history. Their stocks collapsed anyway. On the 28th of July, South Korea's KOSPI index plunged 10.84%. Trading was halted after the market crossed the circuit breaker threshold. Samsung Electronics fell 13.39%. SK Hynix fell 14.65%. Foreign investors dumped approximately 4.97 trillion won of Korean shares in a single session. The next day, the KOSPI fell as much as another 12.6% during trading. In barely 2 days, one of the world's most celebrated AI markets suffered its most violent two-day decline on record. That is the image to remember. A market built on the promise of artificial intelligence stopped in the middle of the day because too many people were trying to escape at once. Every financial bubble has a moment when the story begins to break. The dot-com bubble did not begin collapsing because the internet suddenly stopped working. The housing bubble did not begin because houses ceased to exist. A bubble begins to fail when reality can no longer carry the weight of the expectations placed on top of it. South Korea may be that moment for artificial intelligence. This is not yet the death of the AI boom. It is something more useful and more frightening. The first major warning that even record profits may no longer be enough to support the financial machine surrounding it. This may look like a Korean stock market story. It is not. It may be the opening chapter of the global AI bubble. To understand how South Korea reached this point, we have to begin with the extraordinary rally that came before the crash. The KOSPI gained approximately 76% in 2025. That was its third best annual performance in history, exceeded only by the explosive rallies of 1987 and 1999. By the 22nd of June 2026, the index had reached a record closing high of 9,114.55. This was not a quiet recovery. South Korean stocks had become one of the most aggressive momentum trades in the world. International investors saw a direct way to bet on AI hardware. Domestic investors saw familiar national champions transformed into the companies supplying the most important technological build-out of the century. The story appeared simple. Artificial intelligence required more computing power. More computing power required more memory. Samsung and SK Hynix produced that memory. Therefore, as long as AI investment continued, Korean semiconductor profits and Korean stock prices could continue rising. For a while, the story worked beautifully. Then the market began behaving less like a healthy bull market and more like a machine losing control. On the 23rd of June, the KOSPI fell 9.99%. On the 26th of June, it dropped another 5.81%. On the 2nd of July, it lost 7.89%. A circuit breaker was triggered again on the 7th of July. On the 13th of July, the index fell 8.95%. On the 24th of July, it dropped 5.72%. Then came the historic collapse of the 28th of July and 29. More than half of all KOSPI circuit breakers in the index's history were reportedly triggered during the first 6 months of this year. A mechanism designed for rare emergencies was becoming part of the normal market calendar. That is not what stability looks like. It is what happens when a powerful investment story becomes crowded, leveraged, and dependent on a small number of companies moving in the same direction. Even after the early declines, many investors continued buying. They had learned the most profitable lesson of the previous rally. Every fall was an opportunity. But the same lesson that makes investors rich during a boom can destroy them when the cycle changes. Buying the dip works until the dip is not temporary. Leverage works until the lender decides that patience is no longer part of the agreement. The recent collapse was therefore not one isolated bad day. It was the climax of a market that had been flashing warning signs for weeks. Prices were rising and falling too quickly. Circuit breakers were appearing too frequently. Retail leverage was becoming too large, and the entire index was becoming dangerously dependent on a single global narrative that AI infrastructure spending would rise rapidly, continuously, and profitably. The KOSPI may contain hundreds of companies, but by the peak of the rally, its direction was increasingly determined by two names, Samsung Electronics and SK Hynix. Together, these companies represented more than half of the index's market capitalization. Semiconductor businesses were also projected to produce roughly 67% of the combined operating profit of KOSPI. Listed companies in practical terms, South Korea's national stock market had become a concentrated bet on memory chips. Samsung and SK Hynix together produce roughly two-thirds of the world's memory semiconductors. More importantly for the AI boom, SK Hynix became a leading supplier of high-bandwidth memory, or HBM. These are the memory stacks that sit beside advanced graphics processors and help them move enormous volumes of data quickly enough to train and operate artificial intelligence systems. HBM became one of the most valuable bottlenecks in the AI supply chain. If NVIDIA's processors were the engines, HBM was part of the high-speed fuel system. Demand surged. Prices rose, profit forecasts expanded. SK Hynix was no longer valued as an ordinary cyclical memory manufacturer. It was valued as one of the indispensable toll collectors of the AI age. Samsung was pulled into the same story. The two companies announced vast investment plans for new semiconductor capacity. Their success became the country's success. Their stock prices became the index. Their profits became evidence that the AI revolution was real. But concentration creates a hidden weakness. When two companies rise together, the entire market appears powerful. When they fall together, there is nowhere inside the index to hide. A diversified market can absorb disappointment in one industry. South Korea's market could not. If investors question the future of HBM memory pricing or global data center spending, they were not simply questioning two companies. They were questioning the structure holding up the entire index. The KOSPI had stopped behaving like a broad national stock market. It had become a country-sized leveraged wager on the belief that two semiconductor companies could continue delivering extraordinary growth. This is where the story becomes truly disturbing. Samsung did not enter the collapse with weak earnings. Its second quarter operating profit reached approximately 89.5 trillion won, more than 19 times the level reported a year earlier. Revenue reached approximately 171.5 trillion won. SK Hynix reported record quarterly revenue of approximately 60.5 trillion won. Its earnings had increased dramatically. These were the kinds of numbers most companies could only dream of producing. Investors sold anyways. Hynix fell even after reporting a roughly six-fold increase in earnings. Samsung suffered its worst daily decline in nearly 2 decades. The market was looking directly at record profitability and deciding that the future had become less valuable. That reaction tells us something important. Stocks do not trade on the strength of yesterday's earnings. They trade on the difference between tomorrow's reality and today's expectations. When expectations are low, an ordinary result can send a stock higher. When expectations are extreme, even record profits can feel disappointing. South Korean chipmakers had reached the second condition. Investors were no longer asking whether the companies could make money. They were asking whether they could keep producing almost impossible growth. Could HBM prices continue rising? Could cloud companies keep ordering more chips at the same pace? Would the new factories being built across Asia eventually create oversupply? Would customers design systems that used memory more efficiently? Would Chinese competitors force prices down? And most importantly, would the companies spending hundreds of billions of dollars on AI infrastructure ever earn enough to justify those purchases? The companies did not miss on profits. They missed the fantasy investors had already priced in. This is a classic feature of late-stage market enthusiasm. The business remains strong, but the stock begins falling because the story has become too large for the business to carry. A company can double its profit and still disappoint investors who had positioned themselves for a tripling. It can report record revenue and still collapse if traders believe the record represents a peak instead of a beginning. Memory chips are also deeply cyclical. Shortages create high prices. High prices create investment. Investment creates new capacity. New capacity eventually creates supply, and excess supply destroys prices. The industry has lived through this cycle repeatedly. The AI boom encouraged investors to believe that this time the cycle might have been permanently broken. HBM looked so specialized, demand looked so large, and the largest technology companies appeared so wealthy that traditional limits seemed irrelevant. But factories do not disappear when sentiment changes. Samsung and SK Hynix have discussed combined semiconductor hub investments worth hundreds of trillions of won. Capacity built for an endless shortage becomes dangerous if demand merely grows more slowly than expected. That is why the collapse happened beside record earnings. Investors were not rejecting the present. They were suddenly afraid of the future. China added another layer of uncertainty. For years, Korean semiconductor companies benefited from a technological lead, enormous manufacturing expertise, and restrictions that limited China's access to the most advanced equipment. Investors could assume that Samsung and SK Hynix would remain protected by a deep technical moat. That moat has not disappeared, but it no longer looks impossible to cross. Chinese memory companies, including Changshin Memory Technologies, are expanding production and attracting more capital. Even if Chinese manufacturers cannot immediately dominate the most advanced HBM market, they can still create pressure in conventional DRAM products. Lower prices in those markets can weaken the overall profitability of Korean suppliers and free Chinese customers from some dependence on imports. The model side matters too. More efficient Chinese AI systems have raised the possibility that future models may accomplish more with less computing power. Efficiency does not always reduce total demand. Cheaper computing can create new uses and expand the market. But it does weaken the simplest version of the investment story, the assumption that every improvement in artificial intelligence must require exponentially more expensive hardware. China does not need to defeat Samsung or SK Hynix tomorrow. It only needs to make their future look less perfect. And a stock priced for perfection does not require a disaster to collapse. It requires doubt. The deepest concern, however, is larger than South Korea and larger than memory chips. It is the financial structure supporting the entire AI build-out. Artificial intelligence has become the largest capital expenditure race in modern technology. Companies are spending extraordinary sums on processors, memory, networking equipment, land, electricity, cooling, and data center construction. Those costs arrive immediately. The profits expected from them may take years to appear. That gap has created a complicated financial ecosystem. Chip companies invest in artificial intelligence companies. AI companies raise debt and equity to build data centers. Those data centers purchase chips from the companies financing the ecosystem. The purchases become revenue for the chip suppliers. Higher revenue supports higher valuations. Higher valuations make additional investment and borrowing easier. The cycle then repeats. Reports that NVIDIA might support financing connected to OpenAI's enormous data. Center plans intensified concern about this structure. The issue is not that supplier financing is automatically fraudulent. It exists in many legitimate industries. The issue is what it can hide. If a supplier helps a customer obtain the money needed to buy the supplier's products, the resulting demand may still be real. The servers may still be built, the chips may still be delivered, revenue may still be recorded, but the financial risk has not vanished. It has moved around the circle. The ultimate question is whether the application layer, the businesses actually using AI, can generate enough cash to pay for the infrastructure underneath it. Consumers pay $20 a month for subscriptions. Companies purchase software tools, advertisers buy access to new audiences. Developers use models through application programming interfaces. Those are real revenue streams. But they must eventually support data centers costing hundreds of billions of dollars, enormous power contracts, recurring chip upgrades, and equipment that becomes obsolete quickly. The AI industry does not merely need growth. It needs growth large enough to produce acceptable returns on one of the greatest investment programs in corporate history. This is where skeptical investors such as Jim Chanos focus their attention. Chanos has argued that the incremental return on invested capital at major technology companies has already declined substantially as AI spending has accelerated. If each new dollar of capital produces less profit than the previous one, the industry can continue expanding while becoming a worse investment. Imagine another $1 trillion flowing into AI infrastructure. If that investment eventually produces only $50 billion in annual profit, the return is about 5% before considering all the uncertainty, depreciation, competition, and technological obsolescence. At that point, investors must ask why they accepted equity, level risk for a return that could resemble a government bond. Depreciation creates another problem. A data center may be depreciated over several years on an accounting statement, but advanced AI hardware can become economically outdated much faster when a new generation of chips delivers better performance. The building remains, the equipment remains on the books. Yet the market value of yesterday's hardware may collapse long before the accounting schedule reaches zero. This does not prove that the AI economy is artificial. It shows why the financial returns are uncertain even when the technology works. And South Korea is especially exposed to this question. Samsung and SK Hynix sit near the beginning of the chain. They benefit immediately when customers order more memory. But if investors begin doubting the final returns on AI data centers, the suppliers can be repriced before the cloud companies, software companies, and model developers admit that spending must slow. South Korea may therefore be functioning as the canary in the AI coal mine. The canary does not create the gas. It reacts before everyone else can smell it. Doubt alone does not explain the speed of the collapse. For that, we have to look at leverage. South Korean retail investors had poured enormous amounts of money into products linked to Samsung and SK Hynix. As single-stock leveraged exchange, traded funds spread, ordinary investors gained access to products offering as much as 2 times the daily movement of an individual company. Between May 27 and the 19th of June, retail investors purchased approximately 8.2 trillion won of leveraged single-stock ETFs. About 4.6 trillion won was connected to SK Hynix products, while roughly 3.7 trillion won was connected to Samsung. Margin lending also surged. It reached a record of approximately 38.6 trillion won in June. By late June, South Korea had around 108.7 million stock trading accounts. That does not mean 108.7 million different people were trading. One investor can own multiple accounts. But the number shows how deeply the market had entered everyday financial life. Leverage changes the behavior of a market because it changes who is allowed to wait. An investor who owns a stock with cash can watch the price fall and decide to hold for 10 years. A leveraged investor may not have that choice. When the asset falls, the broker demands more collateral. If the investor cannot provide it, the position is sold. The sale is not based on an opinion about Samsung's technology or SK Hynix's long-term prospects. It is based on an equation. Leveraged funds face a similar problem. To maintain their target exposure, they must rebalance as prices move. In a rapid decline, that can mean selling into a falling market. The lower the market falls, the more pressure the system creates to sell. Prices fall. Collateral values shrink. Margin calls arrive. Funds rebalance. Investors liquidate. Those sales push prices lower, which produces another round of the same process. That is how a correction becomes a stampede. On the 28th of July, foreign investors sold approximately 4.97 trillion won of Korean shares. Domestic retail investors bought approximately 4.33 trillion won. One group was running from the market while another was attempting to catch it. For years, buying every decline had been rewarded. But in a leveraged collapse, the first dip is not necessarily the bottom. It can be the beginning of the mechanism that creates the next dip. Korean regulators eventually responded. New listings and aggressive marketing of leveraged single-stock products were restricted. The minimum cash deposit was scheduled to rise from 10 million won to 30 million won. Regulators were effectively acknowledging that a product marketed as an accessible path to higher returns had also become an accelerant inside a concentrated market. This distinction matters when we ask whether the AI bubble has burst. Part of the Korean collapse was clearly mechanical. Leverage made the fall faster and more violent than a simple change in business fundamentals would justify. But leverage does not create the original doubt. It reveals how many investors were positioned as if doubt could never appear. The market was also losing support from the broader economy. The Bank of Korea raised its benchmark interest rate from 2.5% to 2.75%, its first increase since early 2023. Inflation and financial stability had become more urgent. Higher rates increase the cost of leverage, reduce the present value of distant technology profits, and make safer assets more competitive with expensive stocks. South Korea's household credit had reached approximately 1,993.1 trillion won in the first quarter of 2026. Bank lending continued growing as households borrowed for property and stock purchases. A highly indebted economy is less capable of absorbing sudden financial losses without reducing consumption somewhere else. The Iran conflict and higher oil prices added another problem. South Korea imports much of its energy. Rising oil prices increase costs across transportation, manufacturing, electricity, and household budgets. They also make it harder for the central bank to lower interest rates quickly in response to a market decline. Foreign investors could see all these pressures at once: an extremely concentrated index, enormous retail leverage, rising rates, household debt, higher energy costs, questions about China, and growing doubts about AI spending. None of these factors alone created the bubble. Together, they removed the safety net beneath it. AI valuation concerns created the crack. Leverage, interest rates, oil prices, and foreign selling tore it open. Behind every forced liquidation is a person who believed the story would continue. Many Korean investors did not think they were gambling on obscure companies. They were buying Samsung and SK Hynix, profitable national champions that dominate essential global markets. The companies were real. The factories were real. The demand was real. The earnings were real. That combination made the trade feel safe. But a safe company is not necessarily a safe investment. Price determines risk. A wonderful business purchased at a valuation that assumes perfection can become more dangerous than an ordinary business purchased cheaply. Online discussions captured the changing mood. Some participants described the Korean market as a ram bubble. Others insisted that the sell-off was merely regulators clearing excessive leverage from an otherwise healthy semiconductor boom. Both sides contain part of the truth. Leverage made the crash worse, but investors had chosen leverage because they believed the underlying story was nearly impossible to break. They were not only betting that AI would grow, they were betting that growth would arrive quickly enough, profitably enough, and predictably enough to protect them from the cost of borrowed money. Many of these investors may eventually be proven correct about artificial intelligence. The technology may transform the economy. Demand for memory may continue expanding for years. Samsung and SK Hynix may remain globally dominant. They may simply have paid the wrong price for that future. South Korea has seen a version of this story before. In 1999, the Korean market rose approximately 82.78% as investors embraced the internet and a new generation of technology companies. The excitement was not based on a completely imaginary invention. The internet was real. It changed communication, commerce, media, finance, and nearly every industry it touched. The prices were the problem. The following collapse was brutal. South Korea's KOSDAQ index fell from approximately 2,561 points in 1999 to around 526 points in 2000, losing close to 80% of its value. The dot-com crash did not prove that the internet was useless. It proved that revolutionary technology and a financial bubble can exist at the same time. That lesson is essential today because the AI debate is often presented as a false choice. Either artificial intelligence changes the world and current valuations are justified, or AI fails and the stocks collapse. History offers a third possibility. AI can change the world, create enormous companies, destroy old business models, and increase productivity, while many of today's investments still produce disappointing returns. Railroads transformed entire countries. Railway investors still lost fortunes when too many lines were built. The internet reorganized the global economy. Many internet stocks still disappeared. Fiber optic networks became essential infrastructure. Investors still financed far more capacity than the early market could use. Technology answers the question, can this be built? Finance asks a different question. At this price, with this amount of capital, will the owners earn an acceptable return? South Korea's 76% rise in 2025 was uncomfortably close to the 1999 experience that does not guarantee the same ending. History never repeats with identical companies, products, or regulations, but it often repeats the same human behavior. A real innovation arrives. Early investors become rich, success attracts leverage, valuations become detached from ordinary limits, and the first disappointment is dismissed as temporary. Then the market discovers that a future can be both extraordinary and overpriced. The bearish interpretation is clear. South Korea represents the first market where the AI investment story became concentrated enough, leveraged enough, and expensive enough to break visibly. Record earnings failed to support prices. Concerns about circular financing reached the semiconductor supply chain. Chinese competition weakened assumptions about future margins. Retail leverage transformed selling into forced liquidation. From this perspective, Korea is not an isolated accident. It is an early warning about the economics of the entire AI build-out. If hyperscalers continue spending hundreds of billions of dollars, but their incremental returns keep falling, investors will eventually question every company supplying that spending. Nvidia would face questions about sustainable orders. Semiconductor manufacturers would face questions about capacity. Utilities would face questions about promised data center demand. Private credit funds would face questions about the debt financing these projects. The pressure would travel backward through the same chain that carried money forward during the boom. Jim Chanos and other skeptics argue that this is already beginning. They point to weakening returns on new investment, aggressive depreciation assumptions, vendor financing, and projects justified by short-term chip shortages, even though the facilities will operate for many years. The bullish interpretation is also powerful. AI demand is not imaginary. Samsung and SK Hynix are producing genuine revenue and profit. Advanced memory remains difficult to manufacture. Leading AI models continue improving. Businesses are paying for AI services. Data centers are being built because customers are using the systems, not because every transaction is fictional. SoftBank SoftBank founder Masayoshi Son has argued that treating AI as a simple bubble misses the scale of the transformation ahead. If artificial intelligence produces systems that radically improve research, medicine, manufacturing, logistics, software, and decision-making, today's spending could eventually look small. There is also a reasonable argument that South Korea's collapse was primarily a leverage washout. Regulators tightened the rules. Highly leveraged products were forced to rebalance. Foreign investors fled a volatile market. Once those mechanical positions are cleared, profitable chip companies could recover. That outcome is possible, but a leverage washout and a bubble warning are not opposites. Bubbles often become visible through leverage. Borrowed money allows prices to separate from fundamentals more quickly, and forced selling reveals the separation more violently. The most honest conclusion is therefore uncomfortable. AI is real. The revenue is real. The profits are real. The demand for computing is real. And the financing valuations, concentration, and expectations surrounding AI may still have become dangerously excessive. South Korea has not proven that the global AI bubble is fully bursting. It has shown us what the first stage could look like, not a failed product, not an empty company, but excellent businesses collapsing because investors demanded even more than record results could provide. The next question is whether this pressure remains contained. The United States is not South Korea. American indices are larger and more diversified. The major cloud companies generate enormous cash flows from businesses outside artificial intelligence. NVIDIA holds a different position in the supply chain. American investors do not have the exact same concentration of single-stock leveraged products, but the same financial chain connects them. Microsoft, Amazon, Alphabet, Meta, Oracle, OpenAI, NVIDIA, chip manufacturers, data center developers, utilities, and private lenders are participating in different parts of the same investment cycle. One company's capital expenditure becomes another company's revenue. One company's debt becomes another company's order backlog. One company's promise of future AI income supports another company's current valuation. As long as the application layer eventually produces sufficient cash, that cycle can create genuine infrastructure and enormous wealth. If the final revenue disappoints, the same cycle can transmit losses. That is why South Korea deserves attention far beyond its share of global financial markets. It is one of the places where AI expectations, semiconductor profits, stock market concentration, and retail leverage collided most directly. Korea may not predict the exact direction of American technology stocks tomorrow. It does reveal what happens when investors stop asking how fast AI can grow and begin asking how much money that growth will actually return. The first question creates a boom. The second question can end one. South Korea's collapse does not prove that artificial intelligence is a lie. It proves something more dangerous. A technology can be real, its products can be revolutionary, its companies can generate record profits, governments can support it, customers can use it, engineers can improve it every month, and its stocks can still become a bubble. Samsung and SK Hynix may recover. Memory demand may remain strong. Artificial intelligence may continue transforming the global economy. None of that would erase the warning we have just received. When record profits are followed by record selling, investors are no longer reacting to the present. They are retreating from a future they once believed could not fail. The AI bubble did not need to begin with the bankruptcy of a famous American startup. It did not need to begin with an empty data center or a failed chatbot. It could begin with the companies selling the picks and shovels, the profitable suppliers whose valuations depended on everyone else continuing to dig. That is what makes South Korea so important. The market did not declare that AI was worthless. It declared that the price of the dream had become too high. The bubble has not completely burst, but the glass has cracked. And once the glass cracks, every investor begins listening for the next sound. If history eventually chooses a beginning for the financial reckoning surrounding artificial intelligence, it may circle this week in Seoul. The first major fracture has appeared. Now we find out whether it stops there.